We didn't have any problems out of Chapter 4, but there are some concepts in there that we must discuss and we must understand because these are the building blocks for what will come in the course. So I want to go through this with you in this screencast video. So let's talk about GDP. What is it? It stands for Gross Domestic Product. In economics terms, product is what is commonly referred to as output. That's what we usually call it. GDP is the market value of the final goods and services produced within a country in a given time period. Intermediate products are counted when they are sold in the final product. What that means is if I sell radios for automobiles, the government, when they're calculating GDP, counts the sale of the automobile. They do not count the sale of the radio I made that went into the automobile. If I sell radios to the retail market, so for the aftermarket, then it would be counted in that way. So that's what they're saying. Nominal GDP is nothing more than the GDP. We usually don't use nominal in front of the GDP, but it has the same definition as above. Real GDP is the value of final goods and services valued at the prices of a reference base year. So more specifically, it is the nominal GDP adjusted for inflation. So a year is picked. Currently, they are picking year 2005. The government goes out, counts up all the market value of all the goods and services produced in our country. And then they adjust to the prices that those same goods and services cost in 2005. And that gives them the real GDP, which is a measure of the true increase in output. Okay, now the potential GDP is the maximum level of real GDP that can be produced while avoiding shortages of labor, land, capital, and entrepreneurial ability that would bring rising inflation. It can only be increased if there's an increase in hours worked or a labor productivity increase. There's going to be more on that in subsequent chapters. So the potential GDP is the use of all the land, capital, entrepreneurial ability, and labor that I can use in this country without creating a shortage that would drive up prices. So that would cause inflation, and real GDP is trying to be separated from inflation. Okay, so that's what those mean. Let's look at this circular flow diagram with a few of my comments that I've added. Let us start, in the book they start with households. I'm going to start with firms. Firms go to what is called the factor markets. They need labor, for which they will pay wages. They need land, which is usually paid in rent. They need capital, for which they can provide interest. And they need entrepreneurs, who will be rewarded with profit. That's what a firm needs. Okay, so not every household provides all of that. Okay, you may be in a household where you have no entrepreneurs. You do not start your own businesses. You all work for another company. So you would not be providing any entrepreneurial activity. But other households will. Capital, you all participate in that, whether you know it or not. If you have a checking account, you are providing capital to businesses because the bank where your checking account is lending them money using your money as a foundation for the loan. Land, we have private ownership in this country. Most of the land is owned privately, and private individuals charge rent for their land. And labor, of course, is what we will accept as a wage for helping a firm accomplish its goals. So the firms in the country, many of them, thousands of them, come to the factor markets and look for resources from households in the country. That provides income then to the households. If we follow the Y in economics, Y means income. All right, so the income into the households comes by way of their working for another company, by their renting land, by their providing capital, or by their being entrepreneurs. So firms provide income to households. Households buy things in the goods market. That is known as C, consumer spending. Governments also come in and buy goods from the goods market. So we are all buying things, and the government is also buying things in the goods market. Now, one little note is that firms also go to the goods markets to buy things. They buy equipment. They buy computers and things for their businesses. This is important investments that they make. That's why that is called investments. That investment money makes it back into firms. That doesn't mean every firm gets a return of that, but what it means is all the firms together, that investment money flows in and flows out. So firm A may not make computers, but they need computers to do their work. They go into the goods market and they buy computers, and that money flows back into another firm, firm B. So firm A doesn't make computers, but they buy computers. That is a form of an investment. And firm B, who makes computers, then that investment flows to them. Okay, so that's what they mean by that. Investment money flows out of one firm into another firm. Okay, consumer spending flows through to the firms. Government spending flows through to the firms. And this is imports minus, or exports minus imports. Obviously, when we make something and the rest of the world likes it and they want to buy it, they want to buy a Cadillac, they can buy a Cadillac and we'll ship it over to them. And that's an export. But we may also import Mercedes-Benz from them. We're not talking about anything that's made in the country. We're talking about things that are made outside the country, and we talk about imports. Exports are things that we make in this country. So the net of that difference of those two flows to the firms. Okay, so when the government is trying to calculate what the GDP is in a given moment, they can add up the consumer spending, the government spending, investments, and exports minus imports. If you add those all together, you will get the GDP. And the GDP is also equal to Y, which is the income. So this side of the flow, the income side, equals the expenditure side, which is in the red. So the red flows equal the blue flows. That's in theory. In your text, if you read into it, they'll show you a way that the GDP is calculated looking only at income, the income side of it. And one of the fallacies of the income side of it is you can't capture all the income because there is underground income activities and things of that nature. So the government relies on the expenditure approach, which is easier to nail down. Okay? So what does this all mean? Well, the potential GDP, which is the amount of GDP we could have produced with the labor, land, material, and labor, land, capital, and entrepreneurial ability in the country, we could have produced this black line. And the reason this black line increased over time is either because the population of workers increased, or there were productivity increases, or both, that caused this potential GDP to rise. So if you look at this thing, back in 1960, and we are talking about real dollars here, not inflation, or not inflated dollars. If you look at this thing, back in 1960, the GDP was $15,850 per person living in the country. And recently it was, looks like $42,800 per person. What that means in general for the country is that the country's had a significant increase in their standard of living. That doesn't mean that each individual has had that, because it's measuring all of the country. Income inequalities can exist where Bill Gates got more of that improvement than I did, but I'm not complaining. I feel better off in 2010 than I did in 1960. I can guarantee you that. So anyway, that's what that's trying to do. So that's why we look at potential GDP and we calculate real GDP so we can see what our improvements is. Here's our most recent Great Recession, the effect of it. That cost us lots of money, and we are still not building ourselves back yet to the potential. Notice how the potential is dipping a little bit right in there? That's because the labor force participation rate has dropped. Okay, so we have less people working, and we need to get all that turned around. Hopefully it will. I pray that it will. Okay, so that's it for this one. If you have any questions, you can come to the forums. We can talk about it. But I do believe this is essential for you to understand right at the outset of this course, so you'll be ready for the rest of it. Okay, thank you.